Markets are being forced to rethink the price of risk as a Federal Reserve credibility shock collides with rising long-term yields and a powerful rotation inside technology. Welcome to vTalkInsight, Equity Pulse Daily for August 4th, 2026. The dominant macro story is a loss of confidence in the Federal Reserve's inflation-fighting resolve. Unclear forward guidance has been described as a credibility shock, and the market's response is to demand a higher inflation risk premium, push long-dated yields higher, steepen the curve, and widen credit spreads. 30-year U.S. Treasury yields are now at their highest levels since before the financial crisis, with some desks warning they could move toward 5% if policy communication does not stabilize. The 2-year 10-year curve has swung from meaningfully inverted to clearly positive, tightening financial conditions even without new policy rate hikes, and effectively doing part of the Fed's job. Interest rate volatility jumped after the last Fed meeting, and demand for bond market put options has surged to levels not seen since the global financial crisis. That tells you investors are paying up for crash protection and duration, worried that long-end yields could overshoot and trigger broader market instability. Looking ahead, several Fed speakers are expected to lean more hawkish, with some arguing a September hike may be needed to rebuild credibility. At the same time, talk of reducing the number of policy meetings points to less frequent decisions and less forward guidance, which could leave markets more exposed to data surprises and amplify volatility between meetings. The pressure on U.S. rates is not just domestic. Japan and the U.S. have just confirmed their first coordinated foreign exchange intervention in 15 years to support the yen, reportedly funded in part by selling U.S. treasuries and euro assets, and there is growing concern that continued Japanese repatriation could further erode demand for long-dated U.S. debt. For equities, this backdrop means higher discount rates, more expensive equity risk premia, and a tougher environment for long-duration and capital-intensive stories. Yet the tape still shows resilience, with the S&P 500 rebounding strongly after last week's drop and volatility sliding back toward the mid-teens, underscoring the tug-of-war between macro fear and micro strength. Energy has abruptly flipped from a source of inflation anxiety to a partial relief valve. Brent crude and WTI have fallen around 5 to 7% on the week, as signals of renewed U.S.-Iran talks and progress towards safer shipping lanes through the Strait of Hormuz ease the immediate tail risk of a severe supply shock. Estimates suggest Brent still carries a geopolitical premium of roughly $20 to $25 per barrel, but recent ceasefire headlines have produced sharp, almost mechanical price drops. Storage buffers are not abundant, yet not exhausted, and with the Strait disruption viewed more as a logistical choke point than a loss of refining capacity, any durable reopening could quickly normalize product flows. In equities, the immediate effect is a headwind for listed energy names, particularly in London where the benchmark index is heavily weighted to oil and gas majors, while broader European markets are getting a lift from lower input costs and falling bond yields. In the U.S., cheaper crude is also easing near-term inflation concerns and supporting the latest leg of the equity rally. That said, geopolitical risk has not disappeared. Iran disputes aspects of the negotiation narrative. Shipping volumes through Hormuz remain below pre-conflict levels, and crude has traded in a $20 range in recent weeks, making it hard for markets to anchor expectations and forcing investors to treat energy as a persistent source of macro volatility rather than a settled story. Against this volatile macro backdrop, the corporate earnings picture is surprisingly robust. The latest S&P 500 reporting season is described as the strongest in 5 years, with roughly 86% of companies beating earnings estimates and more than 3/4 exceeding revenue expectations, and aggregate profit growth running well ahead of initial forecasts. On a growth basis, second quarter earnings are landing closer to 35 to 40% year-on-year, versus expectations nearer 25% earlier in the season, with some measures of reported growth approaching the high 40s. Europe is also delivering, where financials benefit from wider net interest margins and energy companies have been supported by previously elevated prices. Importantly, leadership is no longer confined to a handful of mega-cap technology names. There is evidence of catch-up performance in small and mid-caps, emerging markets, and value and dividend sectors, while European banks and industrials have added to the breadth that began to emerge in late July. However, beneath that broad tape lies a concentration issue. A large share of S&P 500 earnings growth is still concentrated in information technology and communication services, and when you strip out mega caps like Alphabet and Amazon, index-level profit growth drops from the high 40s to the high 20s, leaving the market more vulnerable if those leaders stumble. Strong U.S. economic data, including consumer spending growth above 3% and solid business investment in computing, is helping to justify current earnings power. Yet higher long-term yields, wider credit spreads, and larger fiscal deficits mean equities are competing with increasingly compelling fixed-income coupons, so the sustainability of today's valuation multiples hinges on whether this earnings strength can be maintained as the rate backdrop evolves. The most dramatic action inside equities is within technology and AI-linked names. Semiconductor stocks have just endured a drawdown of more than 20% over the past month, the worst since 2008, driven by crowded positioning, leverage in AI trades, and even a forced unwind at a highly levered hedge fund that hit Korean chip names particularly hard. At the same time, hyperscalers are reasserting leadership. Recent results from Amazon and Microsoft highlighted a clear acceleration in cloud demand, while AWS and Google Cloud are posting very strong revenue growth, with some reported cloud growth rates in the high double digits, reinforcing the view that these platforms remain central beneficiaries of the current AI cycle. Investors are becoming far more selective within mega-cap tech. Microsoft is seen as regaining the AI narrative by combining rising capex with positive cash flow, whereas Alphabet faces a discount despite cloud revenues and backlog growing more than 80% and margins approaching AWS levels, reflecting concerns over future capital intensity and messaging. On the hardware side, open-source AI models are a meaningful tailwind for chip demand because large, flexible models require enormous GPU capacity, supporting the structural thesis for NVIDIA and its peers. AMD is also viewed constructively, with its total addressable market for CPUs raised to around $220 billion, thanks in part to strength in inferencing and accelerators, even after recent share price weakness. Still, there is growing skepticism that ever-rising AI and cloud capital expenditure can continue unchecked. Massive project sizes of $10 to $25 billion, rising real rates, and wider credit spreads are pushing up the hurdle rate for returns, while the explosive revenue growth at model providers like OpenAI and Anthropic underscores that much of the economic value may accrue at the software and model layer, not uniformly across all hardware and infrastructure vendors. Beyond listed tech, surging demand for compute and power is driving a multi-year build-out of U.S. data centers and grid infrastructure. Prysmian is leaning into that trend, with up to $10 billion of and firepower and a combined U.S. footprint of around 60 factories after its acquisitions, while digital infrastructure lending is seeing strong capital inflows, wider spreads, and some relaxation of underwriting standards, which together raise the stakes for managing concentration and credit risk in AI-related exposures. Pulling this together, equity markets are balancing a Fed credibility shock, higher long-term yields, and shifting global capital flows against an exceptionally strong earnings season and powerful structural themes in AI and digital infrastructure. The immediate macro risk lies in whether long-end yields and currency dynamics destabilize financial conditions, while on the micro side, the key questions are how long tech-led profit growth can carry the index and which AI and infrastructure projects ultimately earn their cost of capital. From here, the signals to watch are Fed communication and meeting plans, any further U.S.-Japan intervention and Japanese Treasury sales, oil market headlines around the Strait of Hormuz, and ongoing earnings and capex guidance from the major technology and infrastructure players. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.